Welcome everyone to the second quarter commentary for Schneider Downs Wealth Management. As always, I'm Jason Staley, Chief Investment Officer of the firm. With me is my colleague and Senior Investment Analyst, Sean McCann. Welcome.
Thank you for having me.
On one of the few sunny days we've had, kind of feels like we're in Ireland or Seattle in terms of how much rain we've received. So for everyone that has a garden, they're happy. For everyone that doesn't have a garden, just means mowing your lawn more. But anyway, as historic of a rain season as it seems like we've had in Pittsburgh, I think it's a very interesting segue to the markets in the second quarter, which was had their fair share of, how shall we say, kind of spectacular, unexpected, all-time rallies, all-time declines. A little bit of in between, and I think what we've come to learn and come to expect from these markets, especially in the Trump administration, seems like Trump 1.0 and the Trump 2.0, markets are going to be volatile. It seems like, as I thought about and I sat down to write this letter, Sean, it seemed to me that what we just went through, with the benefit of hindsight, you kind of look back and all I could do was laugh.
At the end, the benefit of hindsight, maybe we could laugh. I think during the quarter, especially at the beginning, we weren't laughing.
No, not a lot of laughing. Certainly, as I write about, gray hair producing declines. But I think to put into context exactly what we experienced in April, the market's reaction to the administration's rollout of tariffs, which was so much more in terms of the level of tariffs, the severity of the plan. Even I think the fans of economic isolationism, America First Agenda, were surprised by it. And I think that's what made markets react, is that even the most ardent hardliners of isolationism were surprised at how strong these tariffs were. And the market reaction was what we saw. It reminded me of September of 2008, Lehman Brothers filing bankruptcy. The government the next day taking Fannie Mae and Freddie Mac into economic conservatorship. And then, a day or two after that, stepping in and making sure that AIG was solvent so that it could pay out all of its credit default swaps to what they owed to the financial system, to essentially shore up the financial system. That was how the market was reacting. And I think when Sean and I were talking about how we wanted to put this letter together, I wanted to put in the last concluding paragraph that I wrote in the first quarter commentary, obviously published a couple days after, so we kind of had to include it for market movements. And then Sean wanted to put in the strength of the rally off the bottom. So I'm going to give you what I wrote about in the first quarter commentary, and then Sean's going to tell you about the rally off the bottom in the chart. But I wrote, whether the market is acting rationally or irrationally the last few days, we won't know without the benefit of hindsight. What we do know is that the market declined quickly, with most domestic stocks down over 10% in 2 trading days. Historically, investors have been rewarded for doing one of 2 things when markets decline. 1, stay the course, or 2, stay the course and add some money into the market along the way. Be greedy when others are fearful, as Warren Buffett often says. Neither of those 2 options feel particularly comfortable in the moment, with the former offering slightly more comfort than the latter. It is precisely that discomfort that is, over time, rewarded by the market. Trading in and out of the market has proven incredibly difficult, as the best days in the market tend to cluster around the worst. The largest face ripper rallies tend to occur when least expected, often without any sign prior to the swift upward move. In short, day trading amid market volatility is no plan at all. Instead, when the market gives you a punch in the face as an investor, you flip the switch and revert back to fundamentals. The fundamentals of an investment, financial, and estate plan, fully integrated, will help navigate the ship through tempestuous seas and back to the calmer waters at port. That is the last paragraph, and that's what we wrote at the end of the quarterly commentary, not knowing what was going to unfold in the coming days. And so that provides kind of context as to how we were talking to clients. And then Sean wanted to further put context into the rally that happened after those words were written.
So during the drawdown, we saw U.S. equities anywhere down from 15 to 20% in those first couple of days in April. We did see international equities come down a little bit, but they held up a little bit better than we would have originally expected. And then, as you kind of mentioned, those best trading days cluster around the worst. We saw equity markets almost flip, right, almost in a reversal pretty quickly, but then continue it throughout the quarter, where I think if we look at equities from the trough, from the bottom to where we are today, we saw U.S. equities, basically large, mid, and small, all up close to 25%. I think it was 24% on U.S. large caps, about 23% on the small caps. And then we saw international equities also kind of come back as well. Granted, they weren't down nearly as much, but I think they were up around 19 or 20% off the troughs. Bonds, on the other hand, when we were experiencing all that volatility at the beginning of April, they were actually doing quite well, right? We were in a risk-off environment, so naturally we're going to go to fixed income. We're going to go to bonds for a little bit of, I think you've said in the past, calmer waters in the harbor.
Investors looking for that risk-off asset.
Yeah, and then throughout the rest of the quarter, we saw fixed income kind of give us a more expected return profile of about 2%. So, nothing that's kind of no face ripping on the fixed income side, which is ultimately what we expect.
What we did get, in terms of the unexpected, to put color on what Sean said, what turned the drawdown into a rally was the unexpected nature of when the administration reversed itself on the tariffs, which was completely unexpected. The market was down 3% that day. And I think it ended up closing up like 10, a 1,300 basis point or a 13% move in the domestic large cap market. I think small caps were up like 15 or 16% that day. And it just goes to show you that there was no way to know that was going to happen. The U.S. Trade Representative was in Congress defending the administration's position on trade when the president and the Treasury Secretary kind of set out to reverse or kind of to provide pause for better negotiations in those trade deals, and it just goes to show you there was no hint. It was down 5, down 5, down 5, down 3.
I remember we were talking all day that day, could not believe our eyes what we were seeing. But I think, this shortly after the tariffs were announced, and then we're kind of getting some pullback from the administration. I think this is something that we could probably expect for the next 3.5 years.
I think volatility. I think as you do. Anytime a global economy does a reordering, which
we're in the middle of,
we're in the middle of, it's going to you're certainly going to see that. I think with that as context to what happened in the quarter from a broader sense, let's kind of drill down and get more granular. And I think we start with and have you talk about international stocks.
Yeah, I mean, so through June 30th. So for 2025 so far, international equities, both on the developed and the emerging side, are both performing phenomenally. I think international developed equities are up 19, and emerging markets are not far behind.
15.5, 16.
Yeah, and as you mentioned, we've seen decent economic growth coming out of the Eurozone. We have seen some easing on the monetary policy throughout Europe, throughout other international developed markets, and then we also have. In the M world, China is kind of sitting there with some stimulus that may or may not pass, but it's kind of an option on the sidelines. I think the setup, which we've talked about for, I feel like at least 18 months now or something like that, is kind of why have international markets looked so attractive to us coming into the quarter, and why they continue is, right, we're seeing double the dividend yield in international markets when you compare that back to home. And more importantly, I think when we look at valuations, despite this 19% move upward and outperformance compared to U.S. markets, they continue to look really, really attractive on a relative basis. We're still over, I think it's a 1 standard deviation discount. I think international equities are trading at about a 30% discount right now to their U.S. counterparts. And so, despite this move that we've seen so far over the last 6 months, we think it's something we're really constructive on. I think it's something that we think will continue going into the end of 25 and going into 26.
And I think there are very good reasons for this shift. For those folks that are watching that are maybe have only been investing for the last kind of 10 to 15 years, where the U.S. large cap market's been so dominant, the international versus the non-U.S. versus U.S. stock market outperformance, underperformance is very cyclical. And once an outperformance begins, they tend to continue continue on. And there's some very good reasons for that, right?
Yeah.
So I think, maybe kind of walk through kind of like, I think our approach, kind of why we wanted to, at the end of last year, we increased our position to international and developed, and the 3 reasons behind it, and then the real big catalyst, right? There's a big catalyst that I think really jump-started.
Yeah, I think, well, I already mentioned the fiscal and monetary policy, that kind of coming together that we've seen. The second major talking point that we talked about in the letter is deglobalization. And when we look at U.S. large cap companies, so much of our revenue exposure comes from international. Mm-hmm. And so when we are deglobalizing the world economy, some of that market share is up for grabs. Mm-hmm. And that's where we think international equities are poised to benefit from, right? They're going to be taking some of that share as U.S. companies are kind of looking at looking closer to home. You've talked about how big this 6 months has been and how kind of shocking it's been. One of the most shocking things we saw was the U.S. dollar and the movement we saw on that front. I think it's over 10%.
11% in the first 6 months. It was the sharpest decline on record.
I think the last time we saw something even close to that was in the 1970s. Mm-hmm. And when we talk about globally diversified portfolios, part of that diversification benefit we talk about comes from that currency diversification, right, in the sense of, I think about 9% of international returns were in local currencies. And then when we bring that back home to the US dollar and we factor in US dollar depreciation, we got about another 10%, 11% boost. So the US dollar being a major factor in asset class returns.
And really levered to emerging markets, right? The declining in the dollar and the historical correlation of returns there is pretty strong. And when you look at the setup, right, dollar had benefited from harmony, U.S. dominance in the global economy, being that, there's a reason that they say that the president of the United States is the most powerful person in the world, right? Mm-hmm. And I think as you more regionalize your economy, and you start to initiate efforts to reorganize your economy, reorganize your trade relationships, all of a sudden you don't get the premium you got, right, you were receiving previously. And I think that's why you're seeing, the 10-year Treasury yield being stubbornly high. I think when we walked in here at a 4.42% yield. For the first time in a long time, you saw the dollar declining in value. At the same time, the yields were going up, and as that relationship, price down yields up. Mm-hmm. So you saw bond prices declining the same time the dollar was declining. And so, right, typically that's not historically how it's been. And so I think international stocks are a really good setup for continued good performance, both on a relative and on an absolute basis, which kind of brings us to where we are today, which is, the S&P 500 trading at roughly 22 times forward earnings, which is saying, for every dollar of earnings the S&P 500 generates on a forward basis, you're paying $22 for it. That's expensive. We're back to basically where we were
early 2000s.
Early 2000s, and also kind of where we were at the end of the quarter, where the technology stocks had reached early February before the market started to decline. I think the S&P 500 hit an all-time high kind of in the middle of February, and you had the Magnificent Seven trading at like 28, 29 times forward earnings. That's back where they are right now. When you got to ask yourself, in every market, there's an opportunity. And just like we saw the opportunity in international markets, I think that the opportunity domestically is in small cap stocks, where if inflation continues to cool, the Fed ends its long dated pause and begins its easing, by cutting interest rates, and the U.S. economy continues to chug along and avoids a recession. You have this interesting dichotomy where you have mid caps and U.S. large cap stocks are pricing in like glory days, let risk on, and then small caps are kind of flashing like this yellow light, saying like, I don't know, guys, the valuations, for 4 years, small caps have been dead money. Yeah. Under-owned, under-loved, underappreciated. They have the ability, from a valuation perspective, earnings continue to come up, continued relief from both inflation and interest rates, which hits small cap companies harder than it does large cap companies. That's a part of the market that remains, very interesting to us. And so I think we, will kind of, begin kind of the last chapter of this commentary with looking forward. There are reasons to be both optimistic and pessimistic. The administration has shown flexibility as tariff deadlines have come in, right, to show some sort of progress that allows them to get to a deal where they want to go. Despite the conflict in the Middle East with Israel and Iran still ongoing, if you'd have told me that both Israel and the United States government were going to attack Iran in Iranian airspace in a fashion that was surprising to all, I would have expected the market to not be at all-time highs.
Well, again, it's that reaction, that quick reaction again.
Yes, but so I think that you've gotten through some pretty intense situations, and the market has kind of shrugged it off. Some might view that as complacency. Some might say that the market is really resilient and economic progress is being made and inflation's coming down. I do think that there are some uncertainties, though.
Sure.
And the ongoing Russia-Ukraine, everybody but Vladimir Putin wants this thing wound down. And that has the ability to continue to bog down both the European economy that has been doing so well, and then also kind of with China and Taiwan, and that relationship is just fraught with risk.
Right.
And so there are a lot of uncertainties. It's interesting when you look at the profit expectations. This is the weakest, like in terms of analyst predictions, analyst reports from a profit perspective on the S&P 500 since June of 2023, when interest rates were significantly higher and inflation was still, I think inflation was 3x what it is right now. We also have the ability for these companies to surprise us.
To the upside.
The upside. It is a very, very low bar.
Correct.
When you have that low bar, you have that ability. So we kind of see it there's a part of the market that we think that could certainly go up, and it's there's certainly some things that could bring it down, but I think that speaks to some of the built-in levers that we have to pull on in our client portfolios, and infrastructure being one of them, real assets.
Yeah.
We have a manager that strategically allocates to gold, that I think is really put our clients in position, our portfolios in position to weather the storm. And I think May and June were historically strong. The S&P 500 was up 11% in May and June, totally bucking the trend of sell in May and go away.
Right. Yeah.
At the end of the day, unprecedented things happen in markets all the time, and what we intend to do here at Schneider Downs is do what we've always done, which is when the unprecedented happens, we revert back to the fundamentals. And we're really looking forward to getting out there and talking to all of our clients and prospects, and hopefully some new folks along the way to say what we're doing in client portfolios, to kind of show the progress that was made. I encourage everyone to go look at the charts. I'm going to give you a little preview here. The green bar that Sean put together will make everyone happy. We didn't put the drawdowns in there because I didn't want to get more gray hairs. But until next time, really looking forward to meeting all of you this summer. Hope everyone's having a safe and good summer, enjoying days like today when it's sunny. Until then, Sean, thank you so much for joining.
Thank you.
We will talk to you guys again sometime in October.
Yeah, sounds good.
All right, take care, guys. Bye-bye.